This is IST 302 Group 7 Project Cost Management video. Hi, this is Andrew Steck.
Hello, this is Kedar Dhital.
Hi, this is Kayleigh Saleone.
Our group topic is Project Cost Management. We will go into what is Project Cost Management, the importance of Project Cost Management, the 4 processes for Project Cost Management, including planning cost management, estimating costs, determining the budget, and controlling costs. Then we'll go into the basic principles of cost management, which is profits, life cycle costs, tangible and intangible costs, and benefits and costs. What is project cost management? Cost management is one of the most important functions of project managers. It maintains its important focus at every stage throughout the life cycle of a project. Cost management includes the processes that are required to maintain financial control of projects. It includes economic evaluation, which initiates the project, estimating, organizing, controlling, analyzing, reporting, forecasting, and taking the necessary corrective action. Project cost management is one of the most important aspects of project management that a project team needs to master. PCM includes activities and tools to help complete projects within an improved budget. IT projects have a very poor track record for meeting budget goals, and in a 2011 Harvard Business Review study reporting an average cost overrun of 27%. The most important finding was the discovery of a large number of gigantic overages or black swans, a high-impact event that is rare and unpredictable, but not improbable in retrospect. Cost management includes the processes that are required to maintain financial control of projects. It includes economic evaluation, which initiates the project, estimating, organizing, controlling, analyzing, reporting, forecasting, and taking the necessary corrective action. Planning cost management is the first step in project cost management. It involves planning how the costs will be managed throughout the life of the project. Project costs grow out of the basic documents that initiate a project, like the project charter. Expert judgment, analytical techniques, and meetings are used to produce the cost management plan. The cost management plan typically includes level of accuracy, units of measure, organizational procedures links, control thresholds, rules of performance measurement, reporting formats, and process descriptions. Level of accuracy sets a guideline for rounding or for the amount of contingency funds to include. Units of measure defines each unit used in cost measurements. Organizational procedure links assign each control account a unique code that is used in the organization's accounting system. Control thresholds are the specified amount of variation allowed before action needs to be taken. Rules of performance measurement define measurement rules such as how often actual costs will be tracked and to what level of detail. Reporting formats describe the format and frequency of cost reports required for the project. Process descriptions describe how to perform all of the cost management processes. Cost estimating is the process of approximating the cost of a project over its life cycle. All the resources that will be used by the project need to be considered when developing a cost estimate. Some resources might be labor, materials, equipment, services, or facilities. Cost estimating includes 3 processes: economic evaluation, project investment cost, and cost forecasting. Economic evaluation is the initial planning phase that is used to determine whether a project is economically and technically feasible. Project investment cost predicts the future cost of the project. Cost forecasting is the process of developing the future trends and the assessment of probabilities, uncertainties, and inflation that could occur throughout the project. These three processes help to predict the future financial outcome for a successful project. Once the costs have been estimated for the project's cost baseline can be created. The cost baseline is made by combining the cost estimates of the individual activities over the life of the project and forms the budget for the project. The cost baseline can be used as a performance measure or to determine and justify project funding. During the execution of the project, it is important to monitor the status of project activities. If there is any deviation in the planned schedule, quality, or scope for an activity, the cost will likely be impacted. It is important to evaluate the current status of the project against the cost baseline throughout the project to determine if there is any cost variance for the project. This will provide information on how the project is performing and if any corrective action is needed. The basic principles of cost management include profits, life cycle costs, tangible and intangible benefits, and direct and indirect costs. It is important for IT project managers to be able to present and discuss project information in both financial terms and technical terms, since most members of an executive board will be more familiar with financial terms than they will IT terms. The first basic principle of cost management is profits. Profits are revenue minus expenditures. A company can increase revenue, decrease expense, or try to do both in order to increase profit. When justifying investments in new information systems and technology, it is important to focus on the impact on profits, since most executives are more concerned with profits than any other issue. The second basic principle of cost management is life cycle costing. This allows you to see a big picture view of the cost of a project throughout its life cycle. You can then develop an accurate projection of a project's financial costs and benefits. The total cost of ownership is considered for a project. It is essential for top management and project managers to consider the life cycle costs of projects when making financial decisions. Project managers use cash flow analysis to determine estimated costs and benefits for a project and the resulting annual cash flow. When selecting projects to invest in, top management must consider cash flow concerns as well to ensure that a company is able to support all of its projects and maintain profitability. The third basic principle of cost management is tangible and intangible costs and benefits. Tangible and intangible costs and benefits are categories for determining how well an organization can define the estimated costs and benefits for a project. Tangible costs or benefits can be easily measured in dollars, while intangible costs or benefits are difficult to measure in monetary terms. They often include items like goodwill, prestige, and general statements of improved productivity. The fourth basic principle of cost management is direct and indirect costs. Direct costs are directly related to creating the products and services of a project, while indirect costs are not. Direct costs can include the salaries of people working full-time on the project, and the cost of resources purchased specifically for the project. Indirect costs can include the cost of electricity and other necessities. Project managers should focus on direct costs since they can be controlled, while indirect costs are allocated to projects and project managers have little control over them.